John Woods, Head of Fixed Income Group and Senior Portfolio Manager with Citi Investment Management, joins us live from Hong Kong. John, good morning and thank you for joining us. John, on expected lines, Janet Yellen last night has clearly indicated to the markets that she is not an unknown commodity. She has decided to the same playbook what Ben and Bernanke had put in play in the last 1 year. So if the message is on expected lines, why are financial markets celebrating?
Well, I think markets like some sort of consistency, stability. They like predictability. And in her first major presentation as governor, that's exactly what they got. I think also we had a bit of a boost from the passing of the debt ceiling through the upper house, and that probably gave the market an extra boost. But I think Yellen's comments specifically about not necessarily seeking to raise rates at the forward guidance level of unemployment and 2% inflation also gave some sort of boost. It allows us to focus on the more qualitative aspects of forward guidance, specifically incoming data regarding the labour market and inflation. And so far there are not meaningful signs that that's going to change anytime soon.
So, John, what's your sense? I mean, could we see a meaningful scale-up in the market, or do you think this is just a temporary one-off day when you're seeing a knee-jerk reaction?
Well, look, I think the US market is probably on a secular uptrend for the time being, although nothing like the level of capital gains, for example, that we saw last year. Last year, S&P posted a 30% gain. This year, we expect something closer to a 10% gain, supported by corporate earnings. So I do think that the underlying trend, both in US markets and in the US economy, is positive, and increasingly we're seeing our clients, for example, looking to take advantage of some of the more attractive valuations in Europe and rotating into that part of the world. So from a DM perspective, I think the general story remains positive. The sell-off that we saw, I don't think, frankly, presages any immediate crisis, but obviously for the EM space it's a little different.
John, whereas your clients have the luxury to invest into developed market economies and developed market stocks, some of our viewers don't have that luxury. What really matters to our viewers is that what will happen to flows. The fact that Janet Yellen has indicated that she will continue with the tapering program, is that bad news for emerging markets in general and for those who are buying into Indian stocks?
Well, look, I think that what we're seeing is not an indiscriminate sell-off in EM, but more of a discriminate selling off. In other words, those countries which benefited hugely over the past 10 years in terms of growth are now suffering from structurally high inflation, structurally sectors which are structurally overvalued, and obviously that has an impact on currencies, and we will continue to see an adjustment there. The tapering, I think, is more of a catalyst. What we are seeing actually is a rebalancing in economic growth models from afar afield as Brazil to Turkey to some countries, particularly India and Indonesia in Asia. And until that adjustment plays through in a meaningful way, I think there will continue to be pressure. Conversely, in North Asia, which tends to be more of a surplus type zone, economic zone, if you will, there is a much more positive outlook given the reliance on exports and the leverage play on global growth. So I think we need to be a little more discreet and careful about how we talk to EM. I think no longer is it seen as a single block. It's more a function of underlying economic fundamentals.
And what's the sense that you're getting about emerging markets, though? Because Janet Yellen as well pretty much, said yesterday categorically that some of the emerging markets are in a better shape than one would think, and they have their own stories going on. So do you think emerging markets now are not as much systemic and it's more a specific country-to-country story?
Yes, I think that's absolutely right. I think that the generic tapering story has probably been priced in by EM, but the adjustment process has not been. Now, for example, last night we saw Kazakhstan devalue its currency by some 20%, giving us some indication, obviously, that pressure on EM in some instances remains intense. So the adjustment process that I spoke to obviously needs to see some mean reversion, if you will, in terms of currency valuations, in terms of some inflated property, some inflated sectors in the real economy, such as property, structurally lower inflation, and a moderation in some of the fiscal and external balances that exists. That has been playing through, frankly, since 2011. We have seen, for example, a narrowing in Indonesia's current account deficit and India's current account deficit. So there are improvements at play. It's just that the process is not yet complete. And until it is, and until the market get the sense that we have seen a bottoming out in this adjustment, I think pressure remains.
That's a great point, that we should not differentiate emerging markets into separate economies, into separate pockets. But John, globally, the way flows have moved into emerging markets is that they have always come via the ETF route. And ETF fund managers, they don't differentiate. They pretty much stick to the mandate. So what happens now? Because India dedicated funds are not getting money, ETFs are not getting money, and money is not coming in general to emerging market dedicated funds.
Well, to be fair, let's take a slightly broader picture. Last week we saw two records set in the United States. We saw record inflows into bond funds, and we saw record outflows out of equity funds. It's almost the rotation, the so-called great rotation, in reverse. So it's not just a function of EM. There's an awful lot of liquidity now flowing back into bonds, and to the extent both these inflows and outflows were records, I don't think this is going to be an isolated event. It's true that we are seeing continued outflows from EM. Last week was the 15th consecutive week that we saw outflows, and that's certainly impacting Asia as well. Even China, for the first week in 4, witnessed outflows. So yes, it is a trend that's likely to continue, but I guess my overall point is the market will become more discerning depending on the underlying fundamentals of each economy. And for example, at the point we start to see currencies stabilize and growth start to pick up, and particularly export growth, and for that I look to North Asia in particular, I think we will start to see a more discriminatory approach, inflows towards EM markets.